Hey everyone, Mark here, and with the 2024 U.S. presidential election, well, it's closer than ever.
Oh, yeah, for sure.
So we're going to do a deep dive into a topic that's probably on everyone's minds.
Yeah,
Uh, how might the markets react to a Trump or Harris win?
definitely a big question.
Yeah, don't worry, I'm not talking about which meme coins are going to moon.
Right.
Though if you're looking for those 100x returns,
Oh, yeah.
maybe check out that link in the description. Just kidding.
Uh-huh.
We're going to go for something a little more grounded here today.
Sounds good.
And I'm joined by Anna to help us navigate this complex landscape
Thanks for having me.
using insights from some of the top financial experts out there.
Absolutely.
So we've got a whole stack of articles from Investopedia and Newsweek,
Nice.
and we're going to distill the key takeaways just for you.
That's right.
And speaking of valuable resources,
Yes.
if you're really into this kind of analysis, you should absolutely check out the AI Finance podcast.
Oh, sure.
It's on YouTube.
Great channel.
They do some amazing deep dives on all things finance.
I love that channel.
So you will not regret subscribing.
Absolutely.
So, Anna, one thing that really struck me is how many experts are emphasizing the importance of just staying calm.
Oh, yeah. It's so important.
It's easy to get caught up in all those crazy headlines, right?
Totally.
But Jason Sipperstein from Elliott Rose,
Yeah.
he makes a really great point.
Yeah.
He says, the real risk isn't the election. It's our reaction to it.
Wow, that's so true.
It's that knee-jerk reaction.
Right.
You know, to sell everything when the market dips or chase the latest hot stock tip
Oh, yeah.
based on, who's winning.
I've been there.
That can really hurt you in the long run.
Oh, for sure.
Big time.
Yeah, and Christine Benz from Morningstar.
Okay.
She completely agrees with that.
Okay.
She's all about avoiding those drastic portfolio changes
Yeah.
based solely on, election predictions.
Right.
Instead, she emphasizes the importance of sticking to your long-term investment strategy.
Yeah, you built that strategy for a reason. And one election shouldn't derail all those goals.
That's right.
It's something I think we all benefit from hearing sometimes.
Oh, absolutely.
It's so easy to get caught up in the moment.
Totally.
But here's something that might surprise you.
Okay, I'm listening.
Despite all that volatility
Yeah.
that often surrounds election years,
Right.
most of them have actually seen positive average stock market returns.
Really?
It's true.
Wow.
T. Rowe Price research going all the way back to 1927 shows that
Wow, 1927.
while there are always ups and downs,
Sure.
the market tends to trend upwards over time, even during those nail-biting election years.
That is interesting.
Right.
Yeah.
So that's pretty reassuring.
It is.
So even if things get a bit bumpy,
Yeah.
history is on our side.
I like that.
It's like what William Michael Laughley, a CFP at HBKS,
Okay.
he says, staying invested regardless of who wins,
Right.
generally the best strategy,
Interesting.
because the market tends to, quote, find a way.
Find a way. I love that.
I know, right?
Yeah.
But here's where things get really interesting.
Oh, okay. Tell me more.
Okay, so Megan Gorman
Yeah.
from Checkers Financial Management,
Okay.
she suggests that a divided government
Okay.
might actually be the best scenario for the markets.
Whoa. Hold on. A divided government.
You mean where the president's from one party
Right.
and Congress is controlled by the other?
Yeah. Wouldn't that just lead to more gridlock?
That's what we might think.
Yeah, and less getting done.
Right, exactly.
Okay.
But Gorman's point is that gridlock can actually create a sense of certainty for investors. It limits the potential for those drastic policy changes,
Okay.
which means less risk and more predictability.
So the markets like to know what to expect,
Exactly.
even if it means things move a little slower.
That's a really fascinating perspective.
It is.
Even though we might crave that decisive action from our leaders,
Right.
the market seems to prefer a little bit of a stalemate,
Who knew?
right? But let's get into some specific expert opinions
Okay, let's do it.
on potential election outcomes.
Sounds good.
Newsweek has a great article
Okay.
that outlines some different scenarios.
Okay, hit me with the predictions.
All right, so who's saying what?
Yeah.
So Eric Wallerstein from Yardeni Research,
Okay.
he paints a pretty bleak picture
Oh,
if we have a contested election.
okay.
So a situation where the results are disputed
Right.
and it takes forever to figure out who actually won.
Yeah. Nobody wants that.
He thinks that will be the absolute worst case scenario for the markets.
I can see why all that uncertainty
Right.
hanging over our heads.
Nobody likes that,
Yeah.
especially investors.
Exactly. Wallerstein believes a contested election could trigger a stock decline
Okay.
and a rush to gold as people seek safer havens.
Makes sense.
Yeah, it makes sense.
So a contested election sounds pretty messy.
Definitely.
But what if things go smoothly
Right.
and we have a clear winner? What are the experts saying about the potential impact of a Trump or Harris victory?
Well, Richard Bernstein from Richard Bernstein Advisors, LLC.
Okay.
He's a big advocate for a peaceful transition of power,
Yeah.
regardless of who wins.
Makes sense.
He sees that as the ideal scenario for the markets.
Right. Stability and predictability are key.
Exactly.
But what if one party sweeps both the presidency and Congress? Is that good or bad for the markets?
That's where Bernstein gets really interesting.
Oh.
He actually thinks a sweep by either party could be negative for the markets.
Really?
He's worried that it might lead to unchecked spending
Right.
or tax cuts,
Oh.
which could ultimately harm the economy in the long run.
That's a good point. Too much power in one party's hands could lead to some extreme policy swings.
For sure.
And we've already talked about how the markets hate uncertainty.
Exactly. It's all about finding that balance.
Right.
Bernstein even threw in this fascinating fact.
Okay.
The S&P 500 had the same total return under both Obama and Trump,
Really?
despite their vastly different policies.
That's wild. It really makes you wonder how much presidents actually influence the market in the grand scheme of things.
Right. There are so many other factors at play.
Yeah.
But let's stick with potential election outcomes for a bit.
Okay.
Peter Berezin from BCA Research
Right.
has a slightly different take.
Yep.
He's focusing more on the potential impact on specific asset classes.
Okay, so less about the overall market sentiment
Yeah,
and more about how different types of investments might react.
exactly. For example, Berezin thinks a Democratic sweep could be particularly negative for stocks
Okay.
because of potential tax hikes
Oh, yeah.
on corporations and capital gains.
I see. Higher taxes on businesses could potentially lead to lower profits, which could then hurt stock prices.
Precisely.
Right.
And he also highlights a scenario
Okay.
where a Trump win, but with the Democrats controlling the House,
Oh, interesting.
could be negative as well. He thinks that could lead to a situation with higher tariffs,
Right.
but no offsetting tax cuts.
Oh, so kind of the worst of both worlds.
Right, which could hurt certain sectors of the economy.
Okay, so we've got a few potential scenarios where things could get a bit rocky for the markets.
Yeah.
What about Paul Ashworth from Capital Economics?
Okay.
What's his take?
Ashworth breaks things down even further by asset class,
Okay.
bonds.
Right.
He thinks the worst outcome would be a clean sweep by either party
Interesting.
because it could lead to more stimulus spending
Right.
and potentially higher inflation.
Right. All that extra government spending could make investors nervous about the value of bonds.
Exactly.
Makes sense.
And when it comes to equities,
Okay.
Ashworth thinks a Democratic sweep
Uh-huh.
or a close disputed election
Okay.
would likely be the worst scenarios.
Yeah.
Again, highlighting that aversion to uncertainty.
So are we seeing a pattern here? It seems like most of these experts agree that a close contested election would be bad news
It does seem that way.
for pretty much every asset class.
Uncertainty is the enemy of the markets.
For sure.
Now, when it comes to the U.S. dollar,
Okay.
Ashworth again points to a Harris win
Right.
or a close disputed election as the most likely negative outcomes.
Interesting. So the dollar might be particularly sensitive to the election results.
Seems like it.
But what about the overall economy?
Yeah.
What does Ashworth predict there?
Here's where things get really interesting.
Okay.
He actually sees a Trump win as the worst outcome for the economy.
Hold on. That seems to contradict what some of the other experts are saying.
It does.
Why does he think that?
Unfortunately, the article doesn't go into his specific reasoning,
Okay.
but it does highlight this as an outlier opinion,
Right.
which makes it even more intriguing.
Definitely something to keep an eye on.
Right.
It's a good reminder that these are just predictions,
That's right.
and there's always room for different perspectives.
Exactly, which is why it's so important to consider a range of viewpoints
Right.
and not just rely on one expert's opinion.
And that's exactly why we do these deep dives,
Absolutely.
to get you thinking critically about all the information out there.
Couldn't have said it better myself.
But even with all these different opinions,
Yeah.
some common themes are emerging.
Like what?
What are the key takeaways so far?
Well, firstly, it's clear that the election is going to bring some volatility.
Yeah, buckle up. It's going to be a bumpy ride.
But secondly, and this is crucial,
Okay.
if we look at historical data,
Right.
staying the course and not making any rash decisions
Yeah.
is usually the wisest approach.
Just like that old saying, time in the market beats timing the market.
Exactly.
I love that.
And that's something we really want to emphasize for our listeners.
Right.
You know, this information is meant to empower you,
Yes.
not overwhelm you.
So what does all this mean for our amazing listeners out there?
Yeah.
What should they be doing with this information?
It means that uncertainty is normal, especially during an election year.
Right.
It means that sticking to your long-term financial plan rather than reacting emotionally to short-term market swings
Right.
is probably the best strategy.
Makes sense.
And it means that staying informed is key.
And speaking of staying informed,
Oh, yes.
if you want to go even deeper on these topics
Yeah.
and really understand how AI is changing the game in finance,
Oh, yeah.
you should definitely check out the AI Finance podcast on YouTube.
Such a good channel.
They do an incredible job of breaking down complex financial concepts
Yeah,
in a way that's both informative and engaging.
totally.
It's a fantastic resource for anyone who wants to stay ahead of the curve.
Couldn't have said it better myself.
So with all that said, what else should we highlight before we wrap up this part of our deep dive?
I think it's important to remember that even though the election is a major event,
Yes.
it's not the only factor that influences the markets.
Right.
There's a whole world of other things happening,
Oh, for sure.
both domestically and globally,
Absolutely.
that can impact your investments.
That's a great point. So while we're focusing on the election today,
Right.
it's crucial to keep a broader perspective
Absolutely.
and not get too fixated on any single event.
Exactly. And that's something we'll explore further in the next part of our deep dive,
Okay.
where we'll discuss some specific strategies
Right.
for navigating the markets
Love it.
during this election year and beyond.
Sounds good to me. But for now, let's take a quick break
Okay.
and come back refreshed and ready to dive into those strategies.
Sounds good. See you in a few.
All right, so we've talked about the potential market reactions to the election and all the other factors that could be influencing your investments. But now let's get down to brass tacks. What can you actually do to navigate this potentially turbulent time?
That's the million-dollar question, right? And the good news is there are some concrete steps you can take to feel more in control.
Okay, hit me with those strategies.
First and foremost, remember our mantra, stay calm and stick to your long-term investment plan.
Okay.
Don't let those short-term market swings derail your long-term goals.
Easier said than done sometimes, right?
Oh, absolutely.
Yeah.
Especially when you see those headlines screaming about potential crashes or booms.
Exactly.
But it's important to remember that the market is always going to fluctuate.
Right.
It's like a roller coaster. There are going to be ups and downs.
Yeah.
But if you have a solid plan in place and you stick to it, you're much more likely to reach your destination.
So resist those knee-jerk reactions and keep your eyes on the prize.
Yeah.
Got it. What else can we do?
Another strategy to consider is rebalancing your portfolio. Now, for those who might not be familiar with that term, it basically means periodically adjusting your asset allocation.
Okay.
The mix of stocks, bonds, and other investments you hold
Right.
to make sure it still aligns with your risk tolerance and your goals.
So if one part of your portfolio, say your tech stocks, have been on a tear and are now a much larger percentage of your holdings,
Yeah.
you might sell some of those and reinvest in something that's lagged behind, just to keep things in balance.
Exactly. Rebalancing helps you avoid becoming overexposed to any one particular sector or asset class,
Okay.
which can be especially important during times of uncertainty.
That makes a lot of sense. It's like making sure all the ingredients in your recipe are in the right proportions.
Great analogy. Now, another strategy that can be helpful, especially during times of volatility, is dollar cost averaging.
Dollar cost averaging. That's where you invest a fixed amount of money at regular intervals, regardless of what the market is doing, right?
You got it. The beauty of this approach is that it helps you smooth out the market's ups and downs
Okay.
and potentially lower your average cost per share. So even if the market takes a dip, you're still buying at a lower price,
Right.
which could work to your advantage in the long run.
It takes the emotion out of it and just keeps you consistently investing. I like that.
It's a disciplined approach, which can be really helpful when things feel chaotic. Now, if you're feeling particularly nervous about the market,
Yeah.
another strategy you might consider is increasing your cash position.
So basically, having more money on the sidelines, ready to invest when the opportunity strikes.
Mm-hmm.
Kind of like an emergency fund for your investments.
Exactly. It gives you flexibility and a sense of security knowing you have some dry powder if the market takes a downturn.
But I imagine there's a trade-off there, right?
Mm-hmm.
Having more cash means you might miss out on some potential gains if the market keeps going up.
Absolutely. There's always a balance to strike. That's why it's crucial to weigh the pros and cons based on your individual circumstances, your risk tolerance, and your financial goals.
Right, and that brings us to a really important point.
Yeah.
We're here to provide information and insights, but this is not financial advice.
We can't stress that enough. Everyone's situation is unique, and there's no one-size-fits-all approach to investing.
Yeah.
That's why it's so important to talk to a qualified financial advisor
Right.
who can help you create a personalized plan that aligns with your specific needs.
Absolutely. But with all that said, let's recap the key strategies we've discussed today. We've talked about staying calm and sticking to your plan,
Right.
rebalancing your portfolio,
Yep.
dollar cost averaging,
Uh-huh.
and increasing your cash position.
All great tools to have in your arsenal.
Exactly. And they're not just for election years either.
That's right.
These are sound investment strategies
Yeah.
that can help you navigate any market conditions.
Absolutely.
Right? And it all comes back to that core idea we discussed earlier.
Okay.
Knowledge is power. The more you understand about the markets,
Yes.
the more confident you'll feel making decisions.
And that's what we're all about here at the Deep Dive. Empowering you with knowledge and insights so you can feel in control of your financial future.
I love that.
Me too.
And if you're craving even more knowledge and want to really explore how AI is changing the game in finance,
Oh, yeah.
don't forget to check out the AI Finance Podcast on YouTube.
Such a good resource.
They've got some amazing content that's going to blow your mind.
I agree.
Just search for AI Finance Podcast. Hit that subscribe button and you'll be set.
They're doing some truly groundbreaking work.
Okay, so with all that said, what's the one big takeaway you want our listeners to remember from today's episode?
I think the election is a significant event, no doubt.
Yeah.
But it's not the only thing that matters.
Right.
There's a whole world of other factors influencing the markets.
For sure.
So don't get too caught up in the short-term noise. Focus on the long term.
Okay.
Stick to your plan, stay informed,
Right.
and you'll be well-positioned to weather whatever storms come your way.
Those are wise words, Anna, wise words.
Thanks, Mark.
And with that, folks, we're going to wrap up this deep dive into the election and market volatility.
It's been fun.
But as always, the conversation doesn't have to end here. Stay tuned for the next video on the AI Finance Podcast YouTube channel. You won't want to miss it.
Until next time, keep learning, keep growing, and keep diving deep into the world around you.
See you next time.